I'm Jim Juback, and welcome to my YouTube video for Wednesday, April 26th. Okay, no introduction because this is a really important video and I want to go straight to it and make sure I have enough time. If you like this video, give it a thumbs up. Subscribe to my YouTube channel. That way you get notification when we do the next one. If you want more of my stuff, you can go to my free site, jubackpicks.com. Or you want 6 portfolios instead of 3, you can go to my paid site. That's jubackam.com. A post version of this will be on both sites on Wednesday as well, because it's that important. Okay, title for today is Look Out Below, Central Banks to Take Away $1 trillion in Cash. Okay, this comes from a calculation by Citigroup that looked at how much liquidity central banks had pumped into the financial markets during the Silicon Valley Bank and other bank collapses crisis. And they came to the conclusion that it was about $1 trillion. Now, right now, we're all focused on what's going on with interest rates and what that does to, the cost of money, etc. But there are other places there are other things that drive the cost of money. And Citigroup calculates that the injection of this much liquidity is equal to a rate cut of about 50 basis points. Now, the market right now has decided that it hopes for rate cuts, but it got a rate cut, not in the usual way. And the problem is that the central banks will now stop putting extra liquidity in. So that means we've seen peak liquidity, and they will now try as fast as they can to take some of this liquidity back from the market. So basically what Citigroup says is that, hey, what we had was a risk-on rally that was fueled in its latter stages by all this extra central bank cash. And it made, say, junk bonds really, really attractive. We had a rally in corporate debt. Not because corporate debt was suddenly great because companies were making a lot more money, but because there was more money around and people felt able to take on more risk. So if we're looking at taking this out of the market, the risk spreads will contract again, or actually expand again. So that's the difference between what you get for taking no risk buying treasuries and what you take by buying the risk you take for buying a junk bond. So you get more yield for taking on the extra risk. It means that people will gradually start to take risk out of their stock portfolios as too. So you're looking at, not a crash, but you're looking at one other thing that does suggest that, hey, maybe the first quarter of the year, which saw a really, really strong rally, but that has kind of stalled, does not have an extra bit of fuel from this source either, which if you look at the economy and interest rates and inflation, suggests that there's one more thing on this side of the scale saying this is not the time to take on more risk. And in fact, we might see a risk-off decline in those assets. So thanks for watching. If you like this video, give it a thumbs up and subscribe to my YouTube channel so you notice when they're coming. You can see more of my stuff for free on my free site, jubackpicks.com. It's got 3 portfolios. And if you want 6 portfolios, which includes some options and ETFs, go to my paid site. It's jubackam.com, and you find links to all those down below.